Right. Yes. Very good morning to all of you, and good morning, online students.
Morning, sir.
Morning. Good morning. So, how was the week? Yes. Online students, how was the week? Yeah, I think they are enjoying the week. All of these people in front of me are laughing, right? So I think they are enjoying the week. How about you?
Good, sir. Going on.
Okay, fine. Right. Hey, so it's a long weekend, isn't it? Didn't you go any trips? Tomorrow is also holiday, isn't it? Shall we have a session on tomorrow? Right, okay. So now we are going to look at the final topic in your syllabus. That is working capital management. A very easy lesson. Right, actually nothing to teach in here, but I have to teach. It's very easy lesson, working capital management. Right? Okay, then let us look at the learning outcomes of this particular lesson. So introduction part is there. Thereafter, you are going to learn about concept of working capital management, then the determinants of working capital, and finally working capital financing policy. So working capital management policies. So these are the key learning points that you are going to know once we complete this particular lesson. Right. So this is the this must be the content, right? This is the content, even though I have written it as learning outcomes, it is the content, right? So we are going to look at the introduction to working capital, then what is gross working capital and what is net working capital, then what is operating cycle, right? What is net operating cycle, right? How you determine the working capital requirement, what are the factors that you need to consider, all the things we are going to learn here. Right, so let us look at the introduction part. Now, this topic is a very common topic and a very general topic, very easy topic as well. Right, now, what do you mean by working capital? Working capital means what? In a simple way, yes, working capital is what? It is what? But yes, the amount that you need to run your business, right, day to day. Like for an example, let's say before moving to the corporate finance, let's think about our home finance. Right now, your salary is let's say 200,000. Right, it might be more than that. Right, sorry for underlining. It may be more than that, 2 lakhs. Let's say for a household expenditure, so if you are earning, right, your salary is 200,000. For your monthly expenditure, you have to think. Let's say, no, sorry, like your salary is 200,000. Your salary is 200,000. Out of that 200,000, you have to pay to a bank as a loan 120,000. Example, example. 200,000 is your salary, and you have to pay a bank loan. Usually, agree, isn't it? Yes, because loans are there for us to pay. Right? So, okay. Right. So we are monthly paying 120,000 repayment of loan. Then how much money you have available for you to do other activities? Hmm? It's 80,000. It's 80,000. So that is what we simply call it as working capital or net working capital. Net working capital. Even though your salary is 200,000, but for you to run your day-to-day life, you have only 80,000 rupees with you. Why? Out of your 200,000, you are going to pay 120,000 for that. Okay, so the amount remaining with you to do your day-to-day transaction is 80,000, which means you need to continuously maintain that 80,000, right, to fulfill your essentials. So that is what simply we call it as working capital. Working capital. Then you need to manage that 80,000 properly. So we call it as managing your working capital, right? Managing your working capital. Right. Very easy one. Now, when it's come to this working capital management, it mainly consider about if you look at the statement of financial position. Okay. If you look at your statement of financial position, you have something called fixed assets, right? You have something called fixed assets. On the other hand, you have your current assets, right? Fixed assets and the current assets. Now, when it comes to the fixed assets, the management of fixed assets and the acquisition of fixed assets, everything will be discussed, have been discussed under the capital budgeting, where I have given you a group activity tool, right? Capital budgeting part, how you acquire the fixed assets, how to calculate the NPV and everything. But when we are going to consider about now, this is long term, right? Fixed asset is long term. When we consider about these current assets, it's short term, right? It's short term. This is non-current assets, it's for your long term. This is current assets, this is for your short term purposes. Now, when we refer the working capital management, it's simply how you manage your day-to-day activities in your business, which means we mainly focus on short term. Accordingly, we call current asset management as another name for working capital management, right? Another name for working capital management is current assets management, because we mainly focus on short-term aspect in here, right? Short-term aspect in here. So simply how do you manage your current assets, right? How do you manage your current assets? If you look at your current assets, you have inventories, right? You have inventories. Then you have accounts receivables, right? Account receivables, then cash. So these are the basic things that you have. So you need to manage all of these current assets for the smooth functioning of your business. For the smooth functioning of your business. Is that clear? Right. So here is current assets, and here you have your fixed assets and the non-current assets. Now, when we consider about fixed assets management under capital budgeting, this timing, right? The timing is an important factor. Time. You acquire a fixed asset and you use that particular fixed asset for how many years, right? Based on that, you have to do all the discounting parts, right? And the compounding part. Right? So you need to value the asset. Accordingly, you need to analyze the future cash flows, then you need to discount it. So for you to do such things, definitely the timing is important. And the capital cost of capital, all these things are important. But when it comes to the management of the current assets, we are not using these concepts much. That's the difference. That is the first difference between fixed asset management and the current asset management. Fixed assets is the long term. Accordingly, timing provides a significant impact. Timing provides a significant impact, because when you are going to acquire a particular fixed asset, you need to know how many years that you are going to use it. Right? So accordingly, you need to consider about the discounting as well as the compounding parts. But under the current asset management, we are using such things in a very minor way. Right? Very minor way. Is that clear? And when it's come to the current assets management, there's a particular issue, right? There's a particular issue. We call it as liquidity versus, right? Liquidity versus profitability, right? Liquidity versus profitability. Liquidity and the profitability. Now, the liquidity of the company is entirely depend on their current assets. Agreed? Because all these are highly liquid assets, right? There's a particular order, and that is how you arrange based on the liquidity preference you arrange. First inventory, then account receivables, then bank balances, then the cash. Based on the I think you know these are based on the liquidity. That is how you arrange the items coming under the current assets. So which means current assets, they mainly focus on liquidity, right? Current assets, they mainly focus on liquidity, but that's an issue. Liquidity versus profitability. Now, it is very good to maintain a higher liquidity in your company. Why? If there is a sudden expenditure to be paid, you have certain amounts with you, either to convert it into cash or to do the payments, or you have the cash. Right? So accordingly, your liquidity level is high. Your liquidity level is high. Okay. But on the other hand, it provides a negative impact to your profitability. Negative impact to your profitability. You are maintaining a higher level of liquidity, but on the other hand, your profitability drops. Your profitability drops. How? For an example, you are going to maintain a higher amount of inventories or finished goods in your company. It's good. In terms of liquidity aspect, it's good. But maintaining higher finished goods imply that you don't have much sales. Isn't it? You are having higher amount of inventories or finished goods in your stores, and it implies that your liquidity is high, but you don't have much sales. Accordingly, what happens? Your revenue drops, profit drops. And if you look at the account receivables, maintaining a higher amount of account receivables, in terms of liquidity wise, it's okay. But on the other hand, there's a risk of having bad debtors. Again, the profitability drops. You're maintaining a higher amount of cash balances. Sometimes you're maintaining excess balances here. Accordingly, some of the cash balances are idle. You're not going to use it, right? Then again, what happens? Profitability drops. How? If you have invest those excess cash balances either in the financial markets, right? In the repo market, you are entitled to gain a particular return. You could be credited it under the other income in a P&L, right? So you are going to forget it, that one as well. Okay. So accordingly, it creates some sort of a negative impact, to the company's profitability. Okay, so that is what we call it as the liquidity versus profitability decision, right? Liquidity versus profitability. So you need to maintain. Now you could see here, if you have a higher amount of liquidity, your profitability drops. By considering that you are trying to increase your profitability, then what happens? Your liquidity drops, right? So accordingly, you need to maintain an optimum combination in between these two, right? Optimum combination in between these two, right? Optimum combination. It's very difficult, right? But as a finance manager, you have to decide, right? Based on the available investment opportunities, based on the predicted cash outflows, you have to plan it properly. Okay. So the first difference is the timing and the discounting and compounding techniques. And the second one is liquidity versus profitability. Right. Now, this also impact in terms of depreciation, but it carries for a longer period of time. Right. So that is why we are doing certain bill discounting and all the things here when it comes to receivables management. Right. Sometimes you go for factoring even, right? You sell your accounts receivables to a factoring company and get the money. Right. Is this clear up to now? And the third one is, now you know that if there is a change in the sales volume, right? For an example, let's say now sales are there. Sales could be increased or sales could be decreased. These terms can be happen, right? Now, based on the volume of sales that you are doing or predicted to do, it impact to the level of fixed assets as well as the current assets. Right? If you are going to increase your production massively and you are going to increase your sales massively, definitely you need some of the fixed assets. right? In terms of machineries. Okay. And if you are going to do the same thing, again, you need to maintain a high amount of current assets in terms of inventories, cash, and other current assets. But when it's come to the short term, you can only adjust what? Current assets or fixed assets. When it's come to the short term, you can only adjust current assets to maintain the sales levels, right? To maintain the sales levels. You can only adjust the current assets in the short run, right? If you believe that, yes, the November, December, January season is there, Christmas season. Once we complete the Christmas season, we are going to have the New Year season, right? So seasonal effect is there. So once you identify that, you can purchase raw materials and other relevant current assets to meet that expected sales demand. But you cannot do an immediate change in your fixed assets because it takes time, right? It takes time. So that is the third difference in between fixed asset management as well as the current assets management, right? Fixed asset management as well as the current assets management. Okay, so these are the three things that you have to consider. So please read this and please write this. The first and foremost, you need to have a good understanding about these two, fixed assets management and the current assets management. Right? Fixed assets we consider about longer period of time. Accordingly, this timing is very important, and thereby we use this compounding and discounting techniques. Whereas we use such things in a minor way, it is up to the current asset management since it's short term. And the second one is liquidity versus profitability decision. So when your liquidity is high, profitability is lower. And vice versa. Accordingly, you need to maintain optimum balance in between your liquidity as well as profitability. And the third one is current assets could be changed immediately. Right? If you are going to change your sales, but you cannot do such kind of an immediate change for your fixed assets based on the changes in the sales value. Right? Yes, online students, are you okay with this? Clear?
Yes, sir.
Okay, for you, is it fine? Okay, think practically, yeah? Think practically. Right, so now we are going to look at something called concepts of working capital. Very easy. Very easy. And this entire topic is easy, yeah? The entire topic is easy, you can be happy. Because at the end, we are going to discuss some easy topics. Earlier also we discussed easier topics. Right, okay. So now, concepts of working capital. Right. Now, let's say you have your current assets, right? Let's say you have your inventory amount is 5 million. Then you have accounts receivables, 3 million. Cash balances, let's say 4 million. Your total amount is how much? It's 12 million, right? It's 12 million. Clear? And on the other hand, you have your current liabilities, right? You have your current liabilities. Say you have accounts payables, right? Accounts payables equals to 6 million. Accordingly, your current liability are 6 million. Clear? Current liabilities are 6 million. Right? So current assets is 12 million. accounts payables, it's equal to 6 million. Okay. So we call this as what? Simply the investments in your current assets, right? How much you have invested in your current assets? How much you have invested in your current assets? Huh? 12 million. Okay. So we call it as gross working capital. We call it as gross working capital. The amount that you have invested in your current assets, right? The amount that you have invested in your current assets is known as your gross working capital, right? Gross working capital. Clear? Right? So you have 12 million with you, right? 12 million with you. But out of the 12 million, you have a current liability of how much? 6 million. You have a current liability of 6 million. Accordingly, you have a gross working capital of 12 million. And also you have a current liability, right? You have a current liability minus 6 million. Gross, you have this much, that is your gross working capital. But out of this much, you have to pay 6 million to the outsiders, right? 6 million to the outsiders. Accordingly, you are remaining with 6 million. Yeah, we are remaining with 6 million and we call it as what? If this is gross, the other one is very good. Net working capital, right? Net working capital. Very good. You know everything. It is the first one is gross, the second one is net. Very good. Right. So gross working capital and the net working capital. The amount that you have invested, right? The amount that you have invested in your current assets is known as gross working capital. That is actually that you have, right? But out of this, you have to pay 6 million, which means this is the amount that you could maintain for your day-to-day activities. 6 million, right? 6 million. Think like a home, right? Like we did the previous example, you are earning 200,000. Out of that 200,000, we have to pay 120,000 for the bank. So accordingly, 8,000 is with you, right? So whatever thing that you do, you have to balance in between this particular 80,000. Yes, online students, is that clear?
Yes, sir.
Right, so please read this. Right, very easy, no? So what we have know up to now, the difference between asset management and the current asset management. The concept of working capital, they have something called gross working capital, and the other one is net working capital. How about your assignments? I skipped from the lesson to assignment. Yes, about the assignment, any update? For the assignment, you are going to do your group activity one, isn't it? Group activity, what is the due date? Today. 8 June. 8 July. 8 July. And I think the group assignment. Any update on that? Any update? Group activity to complete. Say now. Did you know that you have been given the group activity? No. Yes, it's online students. Do you know that you have the group activity 2 in LMS? Online students.
Yes, sir.
Okay, good. Right. Yes. Check. Whether you have the group activity 2 in your LMS. Well, maybe assignment is not leaving. That was assignment. Basically, okay, so right, so you can do it on Excel, Excel calculations. It's very easy calculations are there. Right, yeah. Right, okay, now what about your group assignment? Yes, online students, what about the group assignment? Any updates on it? Group assignment? Do you know that you have been assigned a group assignment? No, you know. Yes, online students, any update?
Hi, sir. Good morning.
Yes, good morning. Daniel. Yeah.
So we have some few clarification regarding our group presentation.
Presentation.
Sorry,
I think you are
group.
referring to another subject. I haven't given you group presentation.
Sorry,
Group
the group
assignment,
assignment. Yeah.
Yeah.
Because our topic is impact of capital structure on company's profitability.
Okay, fine.
When calculating the ratios, specifically what kind of ratios we need to focus, we have a doubt because there are many ratios we can calculate. In this scenario, how many ratios we need to consider, and do we need to give some weightage for specific ratios or not? We have a doubt.
Okay, good. Thank you very much. Now, what are the ratios that you have to calculate? It's simply the impact of capital structure on company profitability. Is that Buddha?
Yeah.
Okay, so the capital structure could be considered based on the leverage. It's simply debt to equity ratio. Okay,
Okay, sure.
debt to equity ratio, that is your independent variable, and profitability is your dependent variable. Right? So profitability you could capture by using many ratios. You could go with gross profit margin, but don't go with gross profit margin. Then you could consider net profit margin, then return on capital employed, return on assets, return on equity, return on investments. So those are the variables that you would consider to capture the profitability. Right, so those are the variables to capture the capital structure, debt to equity ratio according to your level, then to capture the profitability, those are the ratios that you would consider. Okay, then debt to equity you can capture to analyze the capital structure as a variable, as a variable to capture the capital structure. Then for the profitability, my advice is you could also find in the previous research articles as well. My advice is go with net profit margin and return on assets or return on equity, because they are on the independent variable you are considering about your capital structure. Accordingly, it would be better if you could compare the capital structure with return on equity. Right? Return on equity as well as net profit margin. With two different dimensions. If you consider about this return on capital employed and return on investment, similar type of ratios, but better if you go with net profit margin and the return on equity. Okay.
Okay, sir.
Okay, good, good. Yes, any doubts on your group assignment? Any doubts? Yes.
And sir, one more help, sir. One more favor, sir.
Yeah, yeah.
So can we extend the group assignment one more week, please? Till July 15th?
Can you explain?
No, can you extend the deadline to
Extend.
July 15th? Yeah?
Extend. Actually, what's your name? You are getting a huge support from here as well, huh? You are getting a huge support from this audience as well. Okay, I'll consider.
Okay. Thank you, sir.
I'll consider.
The
Okay,
consider
okay.
means like some kind of approval, sir.
Sorry, Guna?
It's a consider means some kind of approval actually.
Okay. So we are going to complete the
No, so it takes little bit time actually because we thought that we can finish it fast, but for the research phase actually will take more time to understand the concept and application of all these formulas.
Okay, fine. When you are going to complete your this lecture, final date of the lecture, 15 to 16. It's supposed to have 16, it's not last. Yeah. Supposed to have. Yeah. But the syllabus is all right. We have a bit more common itself. 2 weeks. So apparently, according to the given timetable, you are supposed to complete your semester on 15 to 16. Shall I give the deadline on 15? Is that 15? Okay. Right, okay, please update me on that. I will consider to update it in the exam, please let me know. We might, please, okay, fine. Yes, any other matters relating to your other than any other matters relating to your topics, whether you can understand the topics, are there any issues related with data collection and all? Yes. Yes. Yes, any matters related to group activity, group assignment? Can you understand the topic? Is the topic clear for all? Yes, sometimes can you all understand the given topic or the assigned topic? Yes, can you all understand the given topic or the assigned topic?
Yeah, it's fine, sir. That yeah.
Okay. For this, okay, the topic understood. And do you know how to measure? Right? Do you know how to measure it? Right, literature review part, from the 1 to 2 pages, I have asking you to analyze 3 to 5 pages with the articles and try to summarize the reference. Don't go with that GPT and the right? Yes. Okay, right, fine. You can continue. Any doubts?
Excuse me, sir.
Yes, sir.
Sir, two questions. One thing is how to write the regression equation. I mean, like
Yeah.
how to write the regression equation. Can you explain in the whiteboards how to take it? And other one,
Regression equation.
yes, sir, regression equation.
Okay, fine. Shall I erase this? Online students, I'm going to erase this. First in, first out. Right. Okay. Regression, you're asking Buddha to explain the regression equation, right?
Yes, sir. Depending on the topics, how to write it.
Okay, what's your topic?
It's impact of debt finance to company value.
Impact of debt finance to company value.
Company
Right.
value.
Debt financing. You can also consider this is the format according to your topic. Debt finance to company value. Right. Now, this is your topic, debt financing to company value. Accordingly, you have to measure debt financing as well as you have to measure company value. Again, debt financing can be captured using debt to equity ratio based on your leverage, right? Ratio, debt divided by equity. Sometimes you may find different models if you further read certain articles. And if you look at the company value, there's a particular model to value the company. We call it as Tobin's Q model. Did you find this type of a model, Buddha? Tobin's Q?
Yes, sir, I have mailed you, sir. You have given me some leads to continue.
Okay, right. So Tobin's Q model, or you could consider the market capitalization, and even you could go with the free cash flows, but this is not the time for you to do the free cash flow valuation. You don't have time. Right, so Tobin's Q model is there. It's a particular equation to value the company, and here you have the leverage debt to equity ratio to capture the debt financing. Okay, so what you do, you may have different companies, right? You may have different companies. Let's say company A is there, right? Then company A is there, and you are collecting the data for 2021, 2022. You are collecting the data on leverage, and you are collecting the data on Tobin's Q. Then again, you have company B 2021 data, 2022 data. Company C, this is your Excel sheet, 2021, 2022, right? So we are going to capture the leverage data like this for all the companies, right? Then the value of the company, right? The value of the company. Okay, so simply this is your independent variable, and this is your dependent variable. Am I correct, Huda? Am I correct?
Yes, sir.
Right. Are you also clear with this? Okay. So simply you need to regress, right? Simply you need to regress these two. This is your independent variable. This is your dependent variable. Now, there are several statistical tools available, packages, SPSS, eViews, Stata, right? There are statistical packages available for you to run a regression, but I have asked you to do it by using Excel, right? You can just type on YouTube how to run a regression, how to get the ANOVA table, and even how to interpret. They will provide everything, but I will explain. Right. So you have to run a regression simply regressing these two variables, right? Accordingly, you are getting a particular equation, right? You are getting a particular equation. Now, you know that when it's come to a particular these graphs and all, there's a formula called y equals c plus mx. Can you remember this? In your grade 5 or grade 7, you have learned this. Did you ever thought that you are going to use this after 10 years or 15 years? You never thought. Me too, right? Y equals C plus mx, which means we are analyzing the y variable in terms of other variables, right? Y variable in terms of other variables, right? Now, again, here we say the behavior of the y depends on these two variables. Simply, right? The behavior of the y depends on these two variables, right? So C means it's the intercept or the coefficient, intercept coefficient of a particular graph, right? So you do not want to calculate this because it's automatically given in they automatically calculated that they automatically take. This is your intercept, right? Now, let's say this is what you do. Here, y is your company value, right? Y is your company value because that is your dependent variable, and this is your debt to equity ratio to capture the leverage or debt financing, right? Simply you regress these two data set in the Excel, right? These two data set in the Excel. Then they are providing a particular equation, right? They are providing after analyzing all these data set, they will give you a particular equation, right? They will give you a particular equation. Right? They will give you a particular equation, and it is also coming like this, right? It is also coming like this. For an example, let's say you are getting an equation like this, right? Y equals example y equals 0.5 minus 1.23. This is the equation that you are going to get, right? This is the equation that you are going to get. Actually, sometimes you are going to get this equation using a table, right? So there's a particular table called, let's say, up to now, are you all okay? Fine. Okay. So once you regress this, you are getting a particular table called coefficient table, right? You are getting a particular table called coefficient table, which means it captures, right? Which means it captures this variable x, right? Variable x, and this is the slope related with that. Okay, coefficient table, right? So this table tells you your intercept, what is the value of your intercept, and what is the value of your independent variable, debt financing. Right? This tells you the details about your independent variables. Coefficient table represents that. So here you have a particular beta value, right? Beta means this m bar. Beta means this m. Beta value, we call it as coefficient value. And on the other hand, you have the significant level of that. Significant, right? How confident you are to explain the relationship between these two or the impact. Because we are going to analyze the impact of debt financing on company value, right? Now let's say the intercept value is equals to 0.5 and the debt financing value is 1.5, and the significant level, let's consider it's 0.02 because the significant level must be lower than 5%, right? Significant level must be lower than 5%, which means you are 95% sure that there is an impact, right? And the debt financing beta value is 1.5 and the significant level, let's say 0.03, and again it is less than 5%. You know, significance and confident intervals, right? Confident, when the significant level is 5%, confident is how much? 95. So which means you could say that you are 95% confident that there's impact of debt financing to the value of the company in a very simple way. There's another model, but just based on this. Okay. Now this is the table that you are going to get. We call it as coefficient table. Right? There are some other values as well, but but better to consider the beta values as well as the significance values, right? Beta values as well as the significant values. Okay. Right. Now, based on this, you can develop a regression equation. Right? Based on this, you can develop your regression equation. So you know that it's y equals c plus mx. Right? Y equals c plus mx. So you could say y equals, according to these two, what is your c? C is what? Your intercept. C is your intercept. It's 0.5, and your beta 1 is equals to your net financing variable, right? It's 1.5, right? It's 1.5. Let's say this is minus 1.5, minus 1.5. Right? Likewise, you are going to write minus 1.5 beta 1, right? Minus 5.5 beta 1, right? Beta 1. Okay? Right. Is this clear, Buddha? This is your equation, now. Is this clear?
Yes, sir. This is what I wanted to ask you.
Okay. Now you need to know how to interpret this, right? You need to know how to interpret this, right? You need to know how to interpret this, right? Now, usually we just say this is our intercept, right? We just say this is our intercept. Now here you could see that, look at this, your first independent variable, and that is the only independent variable that you have, the coefficient value or the beta value of that particular independent variable is 1.5, and the sign is minus, which means if the debt financing increased by 1%, the company value will be reduced by 1.5. That is how you interpret the regression equation. If the independent variable increased by 1 unit, right, there's a negative impact to the dependent variable, that is your company value, by minus 1.5. Is that clear?
Yes, sir. Clear, sir.
Good.
Thank
So
you very
this is
much.
your regression equation, and on the other hand, you have to mention something like this. Right? You have to mention something like this. We call this as error term. Right? We call this as error term. Error term. I will explain what is that. Very simple things are error term. Is this clear?
Yes, sir. Clear. Thank you very much.
Okay. Now, when you are explaining this, Putha, you have to tell there's a significant impact because the variables are significant. Right? So there's a significant impact from debt financing to company value, because this relationship we can prove this is significant, right? Isn't it? Statistically proved. We can say that there's an impact of debt financing to company value, because the confident at a 95 confident level, we could say it. So even though sometimes you might get 0.6, 0.7, which means it's not significant, right? But since this is not a research, write the equation like this way and tell this is not significant. Right? The objective is for you to get an understanding on how to run a regression and how to interpret the results. Even though you are getting not significant results, doesn't matter. Right? Tell this is the equation, but it's not significant. Right? It's not significant. Right? It's not significant. And now this is one by one, we say one variable is significant to the model, right? One variable is significant to the model. And you have another particular table which tells you the overall significance of the model. Overall significant. Now here we just consider the significant level of individual variables, right? And you might have heard in statistics there is something called R squared, right? R squared, the model summary, F statistics, right? In your there's a particular table called model summary, ANOVA, right? Model summary, ANOVA table. In there you could see the overall significant level. Overall significant. Whether the entire model is significant or not. Right? Whether the entire model is significant or not. Okay. Is this clear? Clear? Right. So R square means what? You have the data. R squared is what? You have R squared, adjusted R. What do you mean by that? What do you mean by that? Up to now, are you clear? Okay. R squared is what? Now, let's say if you run this particular regression in the model summary table or the ANOVA table, you are going to get a R squared value, let's say 60%. R squared value is 60%. What do you mean by that? R squared is 60%. You have done this. So, what is R squared? What is this?
How much percentage the dependent variable is changing to independent variable?
Is explained. Very good. Huh? What is the percentage that the dependent variable is explained by the independent variables? Very good. Huh? Now we are at 60%, which means your independent variable, that is leverage, the leverage explains 60% of the company value. Clear? Leverage explains 60% of the company value. But what about the other 40? The other 40 would be other variables, which we don't know. That is your error term. Clear? That is your error term. Right? So here, this debt financing explains 60% of the behavior of the company value. Right? 60% of the behavior of the company value. But there is another 40% remaining. We don't know what are those. So all those variables are being captured by the error term. Right? Error term. That's finished. Is that clear? I forgot what is the today's lesson as well. Nah? Right, so is this clear? Okay, so this is what we have to do in this equal. The difficult point is because the time consuming part is the collection of data. Other things are fixing. Right, is this clear, online students?
So one more thing, if we have
Yeah.
2-3 independent variables, so we have to write one regression equation or separately.
One regression equation. In there you have to mention. So if you have two independent variables, which means you have another one here. Right? Simply incorporate this part to here, but at the end, please use this sign, error term.
Okay, so thank you.
Okay, good. Clear? Right. Okay, cross-working capital. Right, shall I erase this? Shall I erase this? Now you can think about your topics as well. right? Okay. Right. So now we are going to look at the, again back to business finance, right? Back to business finance, looking at the management. So now we are going to look at something called operating cycle. Very simple. What is operating cycle? Operating cycle means yes. What do you mean by operating cycle? The time taken in between the initial outlay of the cash and the receipt of the cash by the company. In a very simple thing, right? You are incurring certain amounts to bring the raw materials and you prepare your raw materials, we call that work in progress. Then you convert it into finished goods. Then you do the sales. It takes time for you to receive the sales from your account receivers. That entire time we call it as operating cycle, right? Entire time we call it as operating cycle. So here you could see when it comes to the operating cycle, we have two parts, right? Your gross operating cycle and the other one is your net operating cycle. Right, so here it says the operating cycle is the time duration required to convert sales after the conversion of resources into inventories into cash. And the operating cycle of a manufacturing company involves three phases, right? Acquisition of resources such as raw materials, labor, power, and fuel, then converting your raw materials into work in progress, then into finished goods, then the sale of the product, either in terms of credit basis or in terms of cash, in terms of credit basis or in terms of cash. For an example, let's say for you to bring the raw materials to the company, it takes 20 days, right? It takes 20 days. And to convert the raw materials into work in progress, right? Into work in progress, you took 40 days, right? You took 40 days. Then to convert work in progress into finished goods, right? Into finished goods, usually you take 80 days, right? 80 days. Then what happens? Finished goods, once you done with your product, what you're going to do? Sell. Right? You are going to do the sales, right? You are going to do the sales, right? To do the sales, let's say you have to wait 30 days, right? If you done it by the cash, it's a separate case, then your cycle is over from there. But if you do the sales on credit basis, again, you have to wait another time period to get the money from your account receivables, to get the money from your account receivables. Let's say it's 40 days, 40 days. Okay, now you could see all of your current assets or current liabilities. You have learned something called gross working capital as well as net working capital. So you consider about when you're considering about your gross working capital, it's simply your current assets. Now, if you look at each and every element, now I'm asking whether it is current assets or current liabilities. Current liabilities. Accordingly, current liabilities or current assets. Current assets. Okay, current assets. Accordingly, you are going to get a gross answer here. Right? Gross. That's how these concepts have been devised. You are going to get the answer in terms of a gross value. Gross. What is the final value here? What is the final value? 20 plus 40, 60 plus 80, 140, 130 and 100. What is the final answer? 210. 210 days, right? So 210 days. 210 days. So which means there's a cash outflow and you have to wait another 210 days theoretically to get the money again, right? So we call this as your gross operating cycle, right? It 280, so 210 days, right? So that is why you have the accounting year like 1 year, something like that, right? 280 because all these are converting within the 1 year period. Within the 1 year period. Right? 210 days. Okay. The gross operating cycle. Gross operating cycle. Then what happens? There is some time from your company point of view for you to pay back to your accounts payables. If you have done, if you have purchased something in terms of credit basis, right? In terms of credit basis, let's say it takes 40 days for you to pay to your accounts payables. Right now, here you could see we don't have any account payables, but simply this is how it happens, right? It takes 210 days for you to get the money back, and out of the money that you receive, you take 40 days to pay your accounts payables, right? So simply, your gross working capital, gross operating cycle is 210 days, and your accounts payable period is 40. According to your answer is 170, which is your net operating cycle. Net operating cycle. Right? Net operating cycle. Net operating cycle. If you do not consider the depreciation here, right? If you do not consider the depreciation and anything here, your net operating cycle is equal to something called cash conversion cycle, right? Cash conversion cycle. Cash conversion cycle. Right? If you have any doubt, you can ask. Huh? Operating cycle. Operating. Right? Okay, clear? Right. So these are hypothetical values. I have just taken these things, and all these are hypothetical values, right? Okay, so you could see right now, if you look at the operating cycle, right? If you look at operating cycle, you could see, yes. Now, this is your entire operating cycle, your gross operating cycle, right? This is your gross operating cycle. It's equals to what? Right? It's equals to what? Now, typically, you are purchasing raw materials here, right? You are purchasing raw materials here, and you are converting your raw materials into finished goods, right? You are converting your raw materials into finished goods. So we call it takes some time. So we call that part as inventory conversion period. How many times it takes for you to convert your inventories into finished goods and do the sales, right? So accordingly, that part we call it as inventory conversion period. Inventory conversion period. On the other hand, it takes another period for you to get the money from your accounts receivables, and we call it as accounts receivables conversion period, not price. Accounts receivables conversion period, which means this part. Right? So simply the summation of these two will give you the gross operating cycle. Right? Gross operating cycle. Right? Gross operating cycle. Gross operating cycle is equals to the inventory conversion period plus receivables conversion period. Inventory conversion period plus receivables conversion period. Okay. So then what you do, it takes some time for you to do the payables. So payment for your accounts payables. In here it's 40. Right? So once you deduct that 40 days from your gross operating cycle days, you are getting something called net operating cycle. Net operating cycle. Okay. Net operating cycle. Gross operating cycle equals to inventory conversion period plus debtors conversion period. How many days do you need to convert your inventories to finished goods and do the sales? Then how many days you need to get the money from your accounts receivables? The summation of these two equals to your gross operating cycle. And once you remove the impact of accounts payables from there, you are getting something called net operating cycle. Right? Net operating cycle. So once you look at it, clearly identify this. Right? Your gross operating cycle is equals to inventory conversion period plus debtors conversion period. Right? Inventory conversion period plus debtors conversion period. Inventory conversion period plus debtors conversion period. Okay. Clear? Now, if you look at your inventory conversion period, what are the components coming under it? Inventory conversion period. Now, here the first one is inventory conversion period, right? So, inventory conversion period is the total time needed for producing and selling the product. You know it. Accordingly, these are the components. You have raw material conversion period, work in progress conversion period, and finished goods conversion period. How many days you need to convert your raw material into work in progress? How many days you need to convert your work in progress into finished goods? How many days you need to do the sales after completing the finished goods? Those are the three things here. One, one, two, three. Raw material conversion, work in progress conversion, finished goods conversion. Accordingly, your inventory conversion period equals to this. These three. Yes, online students, are you okay with this? Online students, are you okay with this?
Yes, sir.
Okay, yes, you guys?
Yes, sir.
Okay, fine. Right. Okay, this is how you calculate the raw material conversion period, debtors work in progress conversion period, as well as debtors finished goods conversion period. This is the way that you calculate this, right? If you look at your raw material conversion period, it's simply you have to divide your entire raw material for the raw material consumption per day. Raw material inventory, you are going to divide it by raw material consumption per day. That's why here you could say raw material consumption per year divided by 360, right? Raw material consumption per year divided by 360. Yeah, just excuse. Right. Okay, extremely sorry for the delay. We had a discussion there. Right. Okay, right. So we were discussing about components coming under the cross operating cycle, right? Components coming under the cross operating cycle. So you have something called inventory conversion period, and the other one is debtors conversion period. And this is how you are going to calculate the components coming under the inventory conversion period. Now the first one is raw material conversion. Don't worry, you are not going to get any calculations, right? Right, raw material conversion period. Shall I give? No, it's just simple. I may give a small scenario analysis for you to come up with operating cycle and the next operating cycle. Right? Is that okay? Right. So raw material consumption period, simply you divide your raw material inventory from the yearly consumption, right? But you need to get it to the daily basis. Likewise, you do the calculation for the work in progress as well as finished goods. So it's very simple, isn't it? So if it is raw materials, you are going to divide raw materials. If it is work in progress, you are going to divide work in progress. And if it is finished goods, you are going to divide finished goods from cost of goods sold. The denominator is different. Okay, so these are the components coming under cross operating cycle. One component, inventory conversion period, and the other one is debtors conversion period, which means how many days will it take for your accounts receivables to pay you back. Right, this is how you calculate it. Debtors divided by credit sales per day. Right, debtors, you know these accounting ratios, right? The other one is creditors payable period. Right, so you are using that creditors payable period to calculate what? Net operating cycle. When you are going to arrive at your net operating cycle, you need this accounts payable period, right? Accounts payable period, and this is how you calculate it. Very simple. Okay, so you can have a break. Okay, so online students, you can have a break. Let's limit the break for, yeah, you can come around 10:30. 10:30, right? Online students, 10:30. Yes, my students, are you all there? Online students, are you all there?
Yes, sir.
Right. Right, so we'll continue. Right. Now, the other one, right, listen up. Right, so up to now, what are the things that you know? So at the very beginning, we had a significant discussion about the difference between fixed assets management and the current assets management, and yes, three differences in between those two. Then we discuss about what is the meaning of gross working capital as well as net working capital. Gross working capital means the amount of current assets that you have invested, right? Simply, that is your gross working capital. And once you remove the impact of your current liability from there, you are going to have something called net operating cycle. Okay. Thereafter, we discuss about something called operating cycle. Right? Operating cycle. It's actually we have two parts: gross operating cycle and the net operating cycle. Simply, we say the time period that we have to wait between the initial outlay of the cash and the receipt of the cash by the government. How many days that you have to wait to get the cash. Okay. So once you remove that receivables payable parts from there, you are going to get something called net operating cycle. Right. So this gross operating cycle consists of two things: simply your inventory conversion period plus debtors conversion period. Inventory conversion period is having three components: raw material conversion period, work in progress conversion period, and finished goods conversion period. And there are several formulas for us to calculate them. Then if you look at debtors conversion period, it's simply the number of days that you have to wait to get the money from the accounts receivables. Okay. Right. So once you get the gross operating cycle, and once you remove the days that you have to wait to pay for your payables, you are getting something called net operating cycle. Net operating cycle. And it does not include this depreciation and all these things. We call it equals to your cash conversion cycle. Cash conversion cycle. So here you could see the cash conversion cycle. It's also equals to the gross operating cycle minus net operating cycle. Right? Gross operating cycle minus creditors payable period, right? Creditors payable period. Now, here it says, we'll read the same thing. Now, yeah, net operating cycle could be considered as cash conversion cycle if you don't have depreciation, right? But some says there are two arguments in here, right? So since depreciation is not a cash component, better to remove the depreciation when you are going to arrive at the cash conversion cycle. But some says it would be better to consider the depreciation. Why? Because you are doing the production, and for you to do the production, you need assets, simply your non-current assets. So accordingly, you are incurring a certain payment for that. Based on such scenario, it would be better to consider the depreciation when you are going to arrive at these values. Those are the two arguments. One says better to remove the impact of the depreciation since it does not have any cash figure, it's not cash basis. On the other hand, some says better to include. Why? For you to do the same, you need fixed assets. Right? So when you are losing the fixed assets, it's getting depreciation. So better to consider that depreciation option. That's what they say. Right, so you could see here it says net operating cycle is also referred to as cash conversion cycle. Right? So some argue that depreciation and the profits should be excluded when you are arriving at your cash conversion cycle. Why? It concerns with the cash flows associated with the conversion at cost. It's cash flows. The opposite view is that the firm has to ultimately recover the total cost and make profits. Therefore, they need to consider about depreciation and profits. So also in using the above mentioned formula, the average figures for the period must be used. Usually we are calculating the average figures by considering the beginning value and the ending value. You are going to get a middle point. It's not that much accurate. That much. If you would divide it by 360, that's somewhat okay. Because you are further narrowing down. Right, so this is all about your net operating cycle, and one point that you have to remember here, if you do not have depreciation, your net operating cycle equals to your cash conversion cycle, right? Cash conversion cycle. Okay, so please read this. Simple things, isn't it? Think practically, yeah. You might engage in these activities in your companies. Think practically. Can I use this? Right. Online students, are you clear with this? Online students, are you clear with this?
Yes, sir.
Yes, sir.
Are you all okay? Right. Okay, so now we are going to learn another part called permanent and variable working capital. Right. Okay, now, okay, listen now. So we are going to learn something called permanent working capital and variable working capital. Right. Now, if you look at the company, if you look at the company, let's say this is the time and this is the amount, right? Time is there and here you have the amount, right? Now, for an example, if I ask you a small question before moving to this corporate finance and all, consider the home finance. Do you know the minimum amount that you need to run your family for a month? Do you know the amount that you need to run your family for a month? Right. At least you know it. 500, something like that, don't you? Right? Seriously, I'm asking the amount that you need to have to maintain your basics. To maintain your basics, the amount that you need to have as a family. Do you have an idea? Do you have an idea? Do you have an idea? Right, has a, those who have any idea about that, the minimum amount that you need to run your family for a month. Right, okay, fine, good. Right, so that's a minimum amount, right? So now for an example, let's say at least to do the basics, to eat, right, for medicine, to pay for utility bills, and to bring the fruits and other things to home. That's a particular amount that you need, right? But if otherwise, Putha, you cannot continue your home activity. Sometimes your parents might do, and some those who are married. Right, okay. Okay, yes, online students, do you have any idea about the, I'm not asking the amount, any idea about the amount that you need to have for a month to maintain your basics? Do you have any idea? Definitely you need to.
Yes, sir. We have. Yeah.
Okay, fine. Right. Okay, so usually let's assume that, right? Same thing applies to the company as well, right? Listen now. same thing applies to the company as well. So they need to have a minimum amount to at least run the business, right? Let's say by doing an analysis, they got to know that at least they need to continuously pump to the company to run their business continuously, irrespective of the month, right? Let's say this is January, this is February, March, April, May, June, right? June, then July, August, September, December. September, December. Okay, this is the time period. So they know that continuously they need to pump at least 5 million to the company to maintain their operating activities up to some extent. Without this 5 million, they cannot do it. Right? So that is the minimum amount that the company needs to run their day-to-day activities. Okay, so we call it as permanent working capital. Right? Permanently, you need to pump that capital to your company. Clear? Permanent working capital. Clear? Right. Again, we'll move to the home finance. Now, for an example, let's say you need 100,000 to run your company, so run your home, 1 million. Will it be differ when it's come to the March, April, May, the December, January? Will it be differ? Why is that? Seasonal effect is there. Seasonal effect is there. Okay, good. Let's come to the corporate finance. Now, when it's come to the company as well, they are also facing for this seasonal effect. Right? For this seasonal, now if you look at some textile companies in Sri Lanka, that's the best example for this. Seasonal effect is there. Now, when it's come to the April, May, March, which season? March, April, May in Sri Lanka, which season? Huh? Yes, sir. New Year season, right? So once we end up with the New Year season, then we have what? Wedding season, May. Right? Wedding season is there. So accordingly, these companies, they need to maintain some additional amount rather than the minimum amount that they have, right? So accordingly, this is how the behavior, right? Earlier they start with this, the requirement of the working capital, right? So when it's come to the March, April, May, right? March, April, May, this is the behavior. Right? March, April, May, this is the behavior. Right? You could see there's an upward trend. Right? They need to keep these additional amount because inventories must be kept, finished goods must be kept, because demand is there. So they need to maintain this much of a additional amount other than the permanent amount. Okay. Then again it is smoothly going like this. Right? Now, when it comes to the November, December, again, what happens? You are having the season, Christmas season and the New Year season, right? Christmas season and the New Year season. So you could see this is the additional amount that the company needs to maintain other than their permanent working capital to meet the sudden demand or the seasonal impact, right? So we call this part as variable working capital. Variable working capital. Is that clear? Variable working capital. So no need to write down. Variable working. Get the idea, right? Variable working capital. Now, what do you think? You have observed that there's a particular amount continuously pumped to the company. Will it be changed or remain same? It's also changed. For an example, let's say you are doing 100,000 payments since you're earning 2 lakhs. Right? As a salary, you're earning 2 lakhs. Accordingly, you know that for 12 months or up to some months, you have to incur 100,000 as your expenditure. But for an example, let's say your salary increased from 200 to 250,000. Accordingly, the payment structure also increase. right? It could be increased from 100,000 to 120,000, right? Accordingly, what happens, Huda? This permanent value could also be changed. The permanent value could also be changed. Clear? Let's go to the corporate finance. When it's come to the company as well, when the company is growing and growing, when the company is generating more from their cash cow, what happens? They can increase the permanent working capital as well. They can increase the permanent working capital as well. Accordingly, the graph looks like this. So this is the amount, this is the time period. Now here what happens? Earlier they started with 5 million, but time to time they can increase that permanent working capital as well. Clear? Permanent working capital as well, because now the company is growing huge amount of cash flows, then they can pump those cash flows. And the variable working capital, it remains as it is. It goes the way it goes. This is your permanent working capital. Clear? Yes, thank you. Variable working capital. Variable working capital. Right? It goes like this, the same way, but here now it's changed. Okay. Permanent working capital and variable working capital. Now here you could say, when it's come to the permanent working capital, if you look at the lecture material, it says the minimum level of current assets, right? The minimum level of current assets, which is continuously required by a firm to carry on its business. The minimum amount, at least they need 5 million to run their business. Otherwise, they can't. Right? And it is referred to as permanent or fixed working capital. Permanent or fixed working capital. Okay. And this is the other one, additional amount. Here you could say the extra working capital, right? The extra working capital needed to support the change in production and the sales of a firm is referred to as fluctuating or variable working capital. So sudden demands for you to meet the sudden demands, you keep this amount with you. You keep this amount with you. Okay. Right. Then let's move to the next slide as well. After that, I'll give some time for you to read it. And here you could see, it says this is the behavior, right? This is the behavior. Both kinds of working capital are necessary to facilitate the production and sales through the operating cycle. But the firm to meet the liquid requirements, it's all about your variable working capital, right? Suddenly, accounts payable come and ask, you need to have some amount. Suddenly, demand increases. You need to have some amount to face that demand. Otherwise, you have to exit from the market. So these are highly competitive markets. And this is the second graph that I have drawn here. Now, permanent working capital could also be changed. Right? So here it says, however, the permanent working capital line need not to be horizontal if the firm's requirement for the permanent working capital is increasing or decreasing, would be decreasing over the period. Right? The second graph, right? So for a growing firm, the difference between the permanent and the temporary working capital can be illustrated as a this is how it goes. Right, so this is how it goes. Yeah, okay. So could you please read these two slides? If you have any question, you can ask. Right, okay, so please check whether you agree with these things. Any doubts, we can discuss. If you have any doubts, we can discuss. Yes, online students, are you clear with this? Online students, are you clear with this?
Yes, sir.
Right, okay, fine. So usually you are getting theoretical questions related with this for your paper and it mixed with practical. Right, so now let us look at determinants of working capital. What are the factors that you need to consider when you are going to determine the working capital requirement? Right now, you could see that we are having something called permanent working capital, temporary working capital, and you need to decide that amount. So there are several ratios based on the previous experience of your company. You can decide this is the amount at least we need to have. Based on certain your current assets to fixed assets ratio, you can determine, yes, we are maintaining this much of a fixed assets, accordingly we need this much of a current assets. Likewise. But when you are going to decide that, there are some qualitative factors that you need to consider, right? Qualitative factors, right? Nature of the business. How does it impact on determining the working capital amount? Nature of the business. Nature of the business and the market and the demand. Yes, how will it matter to decide the amount? I mean, the amount of working capital. Now, if you look at the market and the demand, now you got to know that yes, when during the COVID pandemic, right? So once we heard that there will be a close down in the entire economy, right? Economy or like the curfew, where we go first? Where we go first? We go to the food city or we go to the kiosks, right? So a particular person, he used to purchase 1 kilo of a particular thing, but now he's going to purchase more than 1 kilo, right? So accordingly, the food city and the kiosk staff, they need to maintain a higher amount of finished goods with them. So that's how the market and demand gives certain amount of a hint to the amount that the company needs to maintain as their working capital, right? If the demand is less, then they are going to keep less product in the market. Okay. Nature of the business. Nature. If you know that your products are slow moving, are you going to maintain higher amount of working capital or lower amount? Low amount. If you got to know that yes, this particular product is high moving, you are going to keep additional amount that particular product which match for the demand. Okay. Then the other one is technology and the manufacturing policy. What do you think? How will it impact to this particular decision? Technology and the manufacturing policy. And we are using a lot of high tech technologies. Sometimes the amount could be low, right? Because you analyze everything. Even you can estimate the normal process as well as the abnormal process in your production processes. Accordingly, the amount for the units that you are going to create as your working capital will be low, high, low, high, low. It's low, right? It's low. But if you are still using this traditional technology and all, always there's a risk, right? So you need to keep some additional units or additional amount. Then when it comes to this manufacturing policy, now some companies they are having steady manufacturing policies, whereas some companies they are having variable manufacturing policies. If there is a demand, they do the production, right? And some companies that actually depends on the demand. They are having a steady, right? So each and every month, each and every week or quarter, they are producing the same amount of output. So which means it implies that they know the market demand. They know the market demand. So according to it, they have to keep a reasonable amount because they know that yes, every time there's a call from the market. But if you have variable manufacturing policy, what happens? They only purchase the relevant requirement once they get the order. Once they get the order, take purchase and the manufacturing policy. Now, what do you think about the credit policy? Credit policy. Your company's credit policy. Now, credit policy can be either liberalized one or a very strict one. Credit policy means the framework that you are applying for your accounts receivable when it comes to the payments, whether you are granting a significant time period for them to pay you back or a lower time period. Right? So it would be liberalized. Liberalized means what? Yeah, relaxing the credit policy, right? No much any strict rules and regulations, right? But when it comes to the rigid or strict credit policy, you are asking the customers to pay on time. Otherwise, you are removing that customer from your registry, right? That's the two scenarios. Now, if you are having a liberalized credit policy, what do you think? Is it a risk? Everything is risky. If you are maintaining or if you are having a liberalized credit policy, what do you think? Do you need a higher amount of backlogs or lower? Liberalized, which means you are allowing the customers, you are granting more credits, you are not doing much analyzing when usually we are going to grant the credits, we analyze the customers. And if you know the bank, which comes the bank, you know your customers, right? KYC. Likewise, when it comes to the companies also, before granting the credits, we are analyzing whether this customer is good or bad, whether he deals with us before, which type of companies he deals with, what is his cash flows, management team, everything we analyze. Right? So based on that, we are deciding whether to grant the credit or not. Right? So if you are not doing much analysis and you are going to grant the credits, what will happen? Do you want to maintain a higher amount of working capital? No, no. Higher amount. You are not doing the much analysis and also you are allowing the customers to pay within 6 months. Sometimes if they make a call, yes, please extend 1 month without any hesitation, we are going to do it. Which means you are really relaxing your credit policy. You would do because of the marketing, you have to do. You need to market, you need to maintain the cash flow. The one thing is you need to handle the customer. That's the role of the marketing department because when you are going to do as a work, you are really collaborative, right? You could do, but when you are going to do such things, you need to have buffer stocks for cash flows, cash balances with you. Otherwise, it's very difficult. You are liberalizing the credit policy, you are not getting the cash. Then how you are going to do the payments? And if your credit policy is a very strict one, you are doing a significant analysis before granting the credits. You are analyzing the management team, their cash flows, their future businesses. Simply you need to know whether they are in a position to repay you back. Right? So therefore, you have to analyze that company. Right? So you are granting the credits after all these criteria have been met. Otherwise, not. Accordingly, you need to maintain a very low amount of working capital with you. Right? Very low amount of working capital. That's how the credit policy impacts. Okay. And the other one is supplier's credit. Right? Like we allowing our customers, we are also getting certain goods from suppliers. Okay. Now, what do you think? Would you like to pay immediately or would you like to delay? Delay. Usually we know that when it comes to the cash management, we are trying to get the cash inflows as much as quickly. Right? As much as quickly. But when it comes to the expenditure, we are trying to delay the expenditure. Even when it comes to the credit card, we wait till the end of that period. Right? Because we would like to conserve cash with us to pump it to another one. Okay, so expenditure we are trying to delay as much as possible. But when it comes to the cash inflow, we are trying to get it as much as quicker. Accordingly, when it comes to the supplier's credit, what happens? We have to pay for the purchases that we have done from the suppliers. Accordingly, we are trying to delay it as much as possible, but we are doing the payment before we are going to get the penalty. Right? Before we are going to get the penalty. Accordingly, what do you think? Right? You are maintaining a good financial discipline. You could delay, but if you delay further, it impacts your credit ratings. You could delay till the end because it's a period given. You could delay. If that is the case, what do you think? You need to maintain a higher amount of cash to move on. Only because you are delaying till the end and you are doing the same. But if you are a person who would like to do quick payments, you need to have cash balances with you always. You did the credit purchase today and you are going to pay tomorrow. That's your strategy. Would be a strategy. Right? Would be a strategy. Accordingly, you need to keep some additional cash flow. And you did the credit purchase today, what you are paying after 2 or 3 months within the credit period. Then you don't want to keep much cash with you. Right?
Sadhu, in the give a police structure, in our
Right? Okay. Credit policy. Right? That is how the credit policy impact to the working capital. Is that clear? Okay. Then operating efficiency means what? Efficiency means what? Operating efficiency. You are trying to get the maximum at a minimum cost. Right? You are trying to get the maximum at minimum, which means you are trying to minimize the wastages. Yeah. At a minimum cost, you are going to get the maximum. Accordingly, what happened? You are trying to minimize your wastages. Since you are trying to minimize your wastages, the amount that you need to keep as your working capital will be higher or lower? Higher or lower? Low. Right? Because if you know that there's a 1%, right? Yes, once he hold a particular units, 10 units, right? He has to deliver that 10 units to this particular place. Sure, you know that yes, he destroyed nearly 5 units. It's the loss. Right? If you could minimize it, the amount that you need to keep or the unit that you need to keep as your working capital will be lower. Will be low. So that is operating efficiency. And the inflation. What do you think? Inflation. Continuously prices are increasing. Then you need to keep additional amount with you? Obviously. Right? Obviously, if the inflation is there, right? Because today price will not be the price tomorrow. Certain adjustments you have to do. Okay, so that is how the inflation impact on determining the working capital requirements of the company. For you to make that decision, these are some of the variables that you need to consider. Right? Some of the variables that you need to consider. Okay, so it is read and write certain things here. Right, so please check. You can ask any question, any question from this. Stage of the business, how may impact market demand, how may it impact operating efficiency, inflation, technology, manufacturing policy, right? You can ask any question, If you are coming with writing, you can ask any question. Right, online students, are you clear with this?
Yes, sir.
You can ask any question, now. If you are writing the things, facing the struggles, you can ask questions.
Excuse me, sir.
Yes, yes, sure.
Uh, So in generally, is there any generally accepted ratio a company should maintain, working capital ratio?
Yes, now it depends on if you look at this current assets, right? It's now generally maintaining means it's based on the restrictions given by certain loan providers, right? For an example, let's say you have a heavily borrowing, they are asking for you to maintain a proper financial discipline. Accordingly, you need to generally maintain a particular ratio level, right? It could be current assets, or it could be accounts receivables, or quick asset ratio, or immediate liquidity, right? Certain margins must be maintained. It depends on the company, right? So according to your question, yes, you have to maintain certain margins because it could be considered as the benchmarks, right? If you are actually maintaining a lower level for that benchmark, you need to know what are the actions that you need to take. And if you are maintaining over that particular benchmark, again, you are going excessively, right? Again, you need to bring it to the benchmark. Okay.
Okay, sir. Thank you, sir.
Okay, fine. Right. So quick assets ratio, immediate liquidity of the company, right? So usually we say 1 to 2, right? For each and what do you mean by 1 to 2? Yes, what do you mean by 1 to 2? Yes. Now let's say this is the current asset ratio that you have. What do you mean by 1 to 2? To settle one liability, you have two current assets. So that is the usual margin that we maintain. Right, then you have something called acid test or quick asset ratio. Then you have something called immediate liquidity of the company. Immediate liquidity, cash divided by current liabilities. Immediate liquidity, yeah, cash divided by current liabilities. Okay, is this clear? All of you, right? So let us look at issues in working capital management. Right now, the first one is the current assets to fixed asset ratio. Right, sometimes as Janaka mentioned, yes, you need to consider about certain ratios. You're having this much of a fixed assets, then you're having this much of a current assets, whether it is optimum for the company based on your nature of the business. You need to think about it. Right, you have a huge amount of fixed assets with you, but compared to fixed assets, the amount of current assets that you need to maintain would be low. It depends on the nature of the business. Right? It depends on the nature of the business. But if you look at the textiles companies, they need to maintain a significant amount of fixed assets, starting from machineries to factories and stores. And also simultaneously, they need to maintain a huge amount of current assets in terms of finished goods and inventories, and also the cash balances for do the transactions. And the second one we have already discussed, that is liquidity versus profitability. Right? When you are trying to increase your liquidity, profitability drops. When you are trying to increase your profitability, liquidity drops. That's the second issue coming under this working capital management. And the third one is cost of trade-off. Right now, if you look at this particular graph here, I will explain it using this computer because online students also could see this. Yes, now if you look at this particular graph, right? If you look at this particular graph, you could see the vertical axis is right. Online students, can you see this?
Yes,
Can
sir,
you
we can
see
see
this?
it here. Yeah, we can see it here.
Okay, thanks. Now, if you look at this particular graph, Huda, you could see the vertical axis is for your cost and the horizontal axis is for your level of current assets. And this is something like EOQ, right? If you could remember the EOQ graph, this is same as that EOQ graph. Right, okay. Right, so if you look at this particular graph, you have three curves there, right? This curve is upward sloping, we call it as cost of liquidity. And the other curve is downward sloping, we call it as cost of illiquidity. Right, and here you have another curve, and there you could find the minimum cost, total cost curve here, and this is the minimum point. Right, so let's analyze this graph. Now, you would see here, this is the level of current assets that you want to maintain, right? The level of current assets that you want to maintain. Now, we'll start with this particular curve, cost of illiquidity, right? We'll start with cost of illiquidity, right? That curve is downward sloping, right? That curve is downward sloping. So you could see that when the level of current assets are lower, your cost of illiquidity will be high, right? When the level of current assets are lower, your cost of illiquidity will be high. Why is that? Is there any reason? Is there any reason? You are maintaining a lower level of current assets. At that time, cost of illiquidity will be high. Why? Lower level of current assets means your liquidity is lower, which means illiquidity. Accordingly, what will happen? See means here. You are not maintaining a sufficient amount of cash balances in your company. Then suddenly, if you have to do a payment, what you have to do? You have to go for a bank, ask for an overdraft. Then it's a cost. It's a cost. So that's why when you are maintaining a lower level of current assets, your cost of illiquidity will be high. But little by little, when you are trying to maintain a proper amount of current assets, you could say, still you go to the bank, but the cost is low. And still you go to the bank, but the cost is low. Okay? So when you are maintaining this much of a current assets, you could see the cost of illiquidity will be low. Is that clear? Cost of illiquidity. Why? The cost that you have to incur for not maintaining an appropriate level of current assets in your company. Then the other one is Buddha. It's an upward sloping graph. We call it as cost of liquidity graph curve. Cost of liquidity curve. Okay, when you are maintaining a lower level of current assets, cost of liquidity will be lower. Why? When you are maintaining a higher level of current assets, cost of liquidity will be high. Sometimes you are maintaining certain amount of current assets beyond the required level. Understood? Beyond the required level, which means some of the current assets could be idle. Okay, so what you could do, you could invest those excess current assets in the repo market or the financial markets and get returns. So you are not going to do it. You are going to keep all those current assets with you unnecessarily. Accordingly, it is a cost. It is a cost. So that is why when you are maintaining a higher level of current assets beyond the required level, it's a cost. Cost of liquidity. Cost of liquidity. But when you are maintaining a lower level of current assets, what will happen? The cost of liquidity will be low. Cost of liquidity will be low. Okay. So the point where these two curves cross together, we call it as the optimum level of current assets, this point, and at that time, the minimum cost is here. Okay. Minimum cost is here. Optimum point, optimum, not the highest, not the smallest, optimum. I believe that you know the meaning of optimum, right? Optimum. If you maintain a higher amount than the required level, it's a cost. If you maintain a lower balance than the required level, again, it's a cost. Accordingly, you need to come up with the midpoint, right? We call it as the optimum level, where you balance everything, the cost of liquidity as well as cost of illiquidity. Clear? Okay. You could write. Just analyze this graph by your own. Sometimes it could be examined, isn't it? Sometimes it could be examined. Right, so please analyze this graph by your own. Check whether you're okay with this, whether you are in a position to explain this graph by your own. Cost of liquidity increases, cost of illiquidity decreases with the level of current assets. Why? You have a proper understanding. Okay. Right, so please check whether you are in a position to explain these things. Okay, fine. Clear? And check whether you are in a position to explain this. Okay, fine. Clear? Okay. Yes. Okay. Now, if you look at the next graph, right? If you look at the next graph, we are going to discuss that graph in a very detailed manner. Now, usually in a practice, we say if a company is investing without any hesitation in current assets, right? Right, they are not reluctant to invest, they would like to invest in current assets. So we could say that company is following a conservative approach when managing their current assets without any issue. Because some companies are there, they don't like to invest on current assets much due to certain factors. But if a particular company is investing in current assets without any issue, right? Whenever required, we call it is that company is following a conservative approach, a conservative policy. On the other hand, there are some companies, they are not much interest in investing in current assets. Right? Accordingly, we say that company is following an aggressive policy, very aggressive. Yes, there could be a requirement, but they are reluctant to invest. Because as finance accountant and all, we analyze everything in terms of cost and benefit. Cost and benefits. Because there are issues, sometimes some companies, yes, they are reluctant to invest in current assets. Right? So we call that company is following an aggressive policy. And so in between, we have something called leverage. Conservative approach, aggressive. So it is better to have something called leverage. Leverage policy, matching approach. Right, so that is the second graph. Right, second graph. Conservative policy, average policy, aggressive policy. Okay. Right, so now we are going to look at the final part of your lesson 19, if I'm not mistaken. The working capital financing policies. Right, working capital financing policy. Right, now you know how to finance your fixed assets. How? Issuing long-term securities. Right, you issue long-term securities and then you finance your long-term current assets. So likewise, we are going to look at how we are going to finance our working capital, right? How we are going to finance our working capital, right? Now, accordingly, we have to learn three types of approaches or three types of policies. We call it as one is your matching approach, and the other one is conservative approach, and the other one is aggressive approach. Conservative approach, aggressive approach, and the other one is matching approach, right? Now you could see this if I explain this, right? Okay. I think online students you could see this, isn't it? Can you all see this? Online students.
Yes, sir.
Right. Okay. Now you could see that this is the graph that we have discussed earlier, right? So this is your asset side and this is your time, right? Then here you have something called permanent current assets. Can you remember that? Permanent current assets, right? This is your permanent current assets level, right? And here you have your fixed assets, right? Fixed assets there and current assets are there. It could be divided into fixed current assets as well as temporary current assets or variable current assets. Can you remember this graph? Only the additional point here is the fixed asset. Okay. So what happens? This policy is what? Matching policy, which means everything is being matched in this particular policy. Now you could say that you are using long-term sources of finance to finance your fixed assets as well as the permanent current assets. And you are using short-term sources of finance to finance your temporary current assets. It's very well divided, isn't it? You are using long-term sources of finance to finance your fixed assets as well as the part of your current assets, that is your fixed current assets, so permanent current assets, right? And you are using short-term sources of finance, would be current liabilities, something like that, to finance your temporary current assets. So since we do it in a very proper way, we call this as what? Matching approach. Matching. If you match perfectly the sources of finance with its relevant investments, this is the best approach. But when it's come to the practical situation, this will not be happening. Okay, but we could use this as a benchmark when we are going to make the decisions. Clear? So here you could see it says, when a firm follows a matching approach, also we call this as hedging approach, long-term finance will be used to finance fixed assets and the permanent current assets. And the short-term financing has been used to finance the temporary or variable current assets. Okay, so this is the explanation of this graph. However, it should be realized that exact matching is not possible. It's very difficult to match, isn't it? Right? Because of the uncertainty about the expected lives of the assets. Sometimes we cannot measure the expected life accurately, right? One valuer could estimate the useful life of a particular asset as 5 years. Another valuer could come and value a particular asset as 3 years. Right? So it's different, is there. But anyway, it's very difficult to exactly match. Right? Exactly match, but this is the best way. If you do, this is the best way. Okay, so this is what we know as matching approach, where you use long-term sources of finance to finance your fixed assets as well as the permanent current assets, and short-term sources of finance to finance your temporary current assets. Clear? Then, this is what we know as the conservative approach. Conservative approach. Earlier, you got to know that when it comes to practical situation, if the company is investing in their current assets without any hesitation, we call it as conservative approach. Same thing applies here. Right now, you know what is the matching. You know what is matching. If you do this financing in a proper way, this is the way what you want to do. Right. Now, this is what we know as conservative approach. This is a little bit different. Now, you could see here, you are using long-term sources of finance, right? You are using long-term sources of finance to finance your entire fixed assets, as well as entire permanent current liabilities, as well as the half of your temporary current assets or variable working capital. Clear? So if it's a matching approach, you use this long-term finance only to finance your fixed assets as well as permanent current assets. But now you fully finance your fixed assets, you fully finance your permanent capital, and you use certain percentage of long-term financing to finance some part of your temporary current assets as well. Okay, and the remaining part, right? The remaining part of your temporary current assets, you use short-term financing to finance the remaining part of the temporary current assets. Clear? And here you could see there are some points here. Starts to increase, reach a maximum level, then decreases. Here again you have the minimum points, right? Which means in this particular point, Uda, the requirement of your variable working capital would be minimum. It would be minimum. You do not want that much of a working capital, isn't it? Variable working capital. So what you would do, you could go and invest. You may have this much of a cash flows, but you need this much. The excess amount, you could go and invest and earn a return. That is what the point A and point B would be C shows. Okay. Could you please read these two, matching approach and the conservative approach? Right, matching approach and the conservative approach. Huh? Please check whether you are okay with these two, matching approach and conservative approach. Hello. Good morning. Right. Okay. Okay, are you okay with this matching approach? Can you answer any question? Right? How about your confidence about? Did you see the past tense? Easy, no? Easy, right? The past papers and those you have seen, those you have seen the past papers of business finance. Easy, no? Easy or difficult? Right, okay. Fine. Let me explain to the paper part there. Okay. Change approach and the other one is conservative approach. Okay, so what is conservative approach? Good. Good. What is aggressive approach? Yes. Right, okay, so now you have learned that matching approach is there and conservative approach is there. Now, based on these two, can you predict what aggressive approach is? Right now, when it comes to the matching approach, you will use long-term sources of finance to finance your fixed assets and the permanent current assets, and short-term finance to finance your temporary or variable working capital. When it comes to the conservative approach, you use long-term sources of finance to finance your fixed, permanent, current assets, and some part of your variable current assets. And the remaining part of your variable current assets will use to finance by short-term financing. What could be the aggressive one? You are using most of the time short-term financing to finance your variable working capital, permanent working capital, and also what some part of your fixed capital, some part of your fixed asset. That is what we know as aggressive. It's the high risky part. Aggressive, right? Aggressive. You could see here, we are using your short-term financing uh, to finance, right? Short-term financing to finance your variable working capital as well as some part of the permanent current assets. And the remaining part of the permanent working capital as well as the fixed assets, you use the long-term source of finance. And there are some aggressive companies who use short-term financing to even finance fixed assets. That is the riskier part. Why? Fixed assets are long-term. You are generating the returns from the fixed asset in the short run to the long run. Long run. But you have to settle the finance in short run. Can you imagine? It's difficult. So extremely aggressive companies, sometimes they do. They have as much of a confidence, sometimes confidence. You have the confidence. You could choose it. You have the confidence. Okay. Right, so we made this aggressive approach, aggressive approach. Aggressive approach. Right, this is clear. Aggressive approach. Contact students, are you clear with these three policies? Matching approach, aggressive approach, and conservative approach. Are you clear with these things?
Yes, sir.
Right, students? Right. Okay, so that's the end of this. Now, these things you know, short-term versus long-term financing when it comes to risk, right? Cost, flexibility, and also the risk that we have already discussed these things. Right? And your syllabus is over, right? The syllabus is over. Cash management strategies and receivables management strategies. I know you know it. Right? Certain things. You only want to know about financial. Even you can practically write what are the receivables management strategies. You can practically Right. So there's another small part for the introduction to derivatives. Right. So 5% have been allocated at least much that much we get. There's a 2 page what we can it will miss. Right. Now if you look at your syllabus, now you have to complete 3 assignments, isn't it? Group activity 1, given, already submitted. Group activity 2, given, still not submitted. Group assignment, given, still not submitted, requested to extend the deadline. So could you please make a request to them? Make a request, email request to make a request. So then I'll consider to extend the time period till 50, 70. What else? So your paper structure. That is the most important thing, isn't it? Right. Your paper structure is very easy. Right. If you look at your paper structure, Muta. So you have enough time period, right? You have enough time period to study business finance to complete the assignments, right? To complete the assignments as well. Right. Now, if you look at your paper structure, right? Do you need a difficult paper or an easy paper? Easy paper. Okay, good. I'll provide you a standard paper. Not even difficult, not even easy, optimal, right? Standard paper. Right. So your business finance, right? Nice subject. Business finance paper consists with 2 sections, right? Section 1 and the other one is section 2. Section 1 and section 2. Right? Such a enthusiasm, right? Section 1 and section 2. Right? Section 1, you are going to get a compulsory question. Right? You are going to get a compulsory question. It may either from cost of capital or valuation or both. right? It could be either from cost of capital, valuation, or from both. And 28 marks have been allocated for this, right? 28 marks. So 100 minus 28 equals to 72. 72 divided by 4, 18, right? So if you look at the section 2, right? Section 2, you have options, right? You have options, right? You will be given near, could be changed. 5 questions, out of which you have to answer 4. Right? 5 questions, out of which you have to answer 4. And it covers all the other elements. Other than, it's very simple, isn't it? Right? Now, right, if you are, I think online students, can you all see this? Is it visible to the online students?
Yes, sir.
Yes.
Okay. Now, if your compulsory question comes from, this is the main key point. If your compulsory question comes from cost of capital, definitely there's a question from valuation here. If your compulsory question is from valuation, definitely there's a question from cost of capital here. Okay. If you have both, you are having both. We'll see. Definitely you may have another one. It depends on the weightage. If I am providing the question for both valuation and cost of capital, if the major part is from valuation, then you may have a cost of capital here. If the major part is from cost of capital, the valuation part here, right? Okay. Okay. So now what are the topics that we have covered? Introduction to financial market, finance, financial markets. I have given you an assignment on time value of money, right? Then cost of capital, valuation, dividend policy, risk and return, capital structure, capital budgeting assignment, then working capital management. Okay. Now, when it's come to the section number 2, yeah, those are the topics that you need to consider. Right, so your question number 1 from introduction to finance and from financial markets. Right, so question number 1 from introduction to finance and financial markets. Okay, and question number 2, because this is question number 1. This is your question number 1, compulsory question. Question number 2, starting from section number 2, is from introduction to finance and financial markets. Right, then question number 3 is from risk and return and portfolio management. Question number 4 depends. Why? It depends on the compulsory question. Right? Question number 4 depends on. So that question number 4 is the dependent variable. These are the independent variables. Right? Question number 4. Yes, Buddha. 5 papers. Past papers are there.
You want to repeat that question?
How do you know?
I went through.
Okay, usually it's standard. That is what I asked you at the very beginning. Do you want an easy paper or a difficult paper? The paper is standard. Repeating questions is not necessary, isn't it? But I believe that you all could get a good results, right? Hopefully, entire match A classes. That's my issue. Right, okay. Right, listen. Okay, so question number 2 is from introduction to finance and financial markets. Question number 3 is from risk and return and portfolio management. Question number 4 depends on this. Okay, question number 5 is from could be from dividend policy and working capital. Question number.
One question. Can you include the practical question then?
Yeah.
But the theory.
What?
No, apart from the theory.
Yeah, usually I do it. That's how the weight mark is structured, isn't it? First, I'm giving you a chocolate for 3 months. Right? Then you choose for 5 months. Then chocolate with chicken curry. No, you cannot be with chocolate. That's the practical question. Huh? Right, okay. Okay, so question number, okay, so here this is question number 1. I'm forgetting, right? Question number 2. Question number 3 is from risk control and portfolio management. Question number 4 could be from capital structure and dividend, sorry, capital structure and working capital management. Question number yeah. Depends. Question number 5 could be from capital structure and working capital. Question number 6 could be from dividend policy and working capital. Sometimes small amount of capital budgeting could be there. But small part of the capital budgeting could be there. Okay? Capital budgeting, time value of money. Right? Clear? Okay? Right, so for time value of money and the capital budgeting, you have been given an activity, right? So sometimes based on that, I'm not going to evaluate since I have already evaluated it. But small question could be there. Could be there. Okay. Right, so the entire marks for the paper is 100. Right, for each and every question, you are getting 18 marks. So this is your structure for the business finance paper. Compulsory question nearly for 2 or 3 pages. But it's very easy, right? We integration is this, and I ask you to do another question. Right? You know the steps, right? It is a back for valuation, whatever. You know the steps. Follow the steps, you can have the answer. And also, you will be given the equations as well. Right? Formula sheet. And please note that formulas like IRR, earnings per share, right, will not be here. Right? Will not be given. And the formulas which is relevant for you to calculate certain advanced things will be here. Right? Cost of equity, right? Valuation, there's no any particular formula, simply you need to discount your future cash flows. Right? There's only one formula is there. If the dividend is growing in perpetuity to calculate the price. Right? For the dividends, if there are any questions on calculation, we will be given the equations as well. Right, so not all, the required formulas will be given. But please note that formulas like will not be given. Yeah, okay. Right, so I believe that you all would provide a better results for the business finance. Right, so that's the end of your syllabus, and that's the end of your business finance journey. Right. Thank you very much, all of you. It's a great pleasure for me to teach you all. Right, it's a great pleasure for me to teach you all, and most probably this is the end of my journey with you all. Right, really happy to teach you all, and I believe that you have taken some points in this particular lesson, because this is most of the students, they believe this is the most difficult course unit in their syllabus. Why? Still they haven't done the corporate finance and risk management part in the final year. Right? Okay, but it is both of all these subjects are very easy. Concern more and if you think practically. right? Because all these subjects are practical, right? You know the steps of doing the particular calculations, and you know how to answer a particular question from the business economic class. You know these things, how to identify the action verbs and everything, right? So, yeah, that's it. It's a thank you very much because I never thought I have to complete this syllabus during the given period, but it's went well. It went well, not because of me, because of you. Your support is tremendous. Right? And even you ask so many questions, actually, I like it. You have to ask students because earlier we believe that this is lecture centered education, but now it's student centered. Right? You have to ask questions. You have to ask questions, and I believe that I have given reasonable answers for the questions that you have asked. And so you have to ask questions. Personally, I like it. I like it. If I can conduct the lecture based on the discussions, actually, I like it. But we have learned, and simultaneously we have discussed the theoretical parts as well. Right? Okay, so 2 assignments must be submitted, and you have ample time to do it. Group activity 2 is the one next week, and group activity assignment without this areas have considered extend the deadline till 15th of July. Right, 15th of July. Right, so we have the time to study actually. Nominally, nominal values and real values. Nominally, you have the time, but if you convert into real values, the time is less. So accordingly, please prioritize the activities, right? Please have a proper idea about from which point you are going to start business finance, right? Different students may have difficulties in different topics. Better you start from the difficult topic, right? Better you start from the difficult topic, but please note that for you to understand certain difficult things, you need to know the basics. Without basics, you may understand the difficult things, but if there is a shuffle in the question, you may struggle. So accordingly, you need to have a better understanding about from the ground level to the 3-story. Right? So better to start from the beginning. Have a time. I know that you all are busy, but you have to study and you have to write the examination. You have a far, isn't it? Far in finance, it's far HR, nice, it's far HR. It's very nice. It's tiny. It's far HR, BA, then. And yes, my job is also easy, but you can very good understand it. Audit? Do you have audit? No, no. Right, so tough subjects are there, challenging subjects are there. We cannot ignore any subject like this subject easy. Standards, all the subjects are standards and the papers will also be standard. So please get ready for that. Study well. Okay, thank you very much and good luck to all of you. Right? Stay safe and have a nice time. Good luck, class. Yes, online students, any doubts, Budala? Any doubts? Online students? Yes, listen now. Yes, online students, yes, and thank you very much, Ashraf, Afras, and Pavani is not there, but yes, Pavani, thank you very much, and Karnasena, Janaka, Gayan, Sadharwan, all the online students who joined to the lecture through online platform, thank you very much for your tremendous support. Yes, so good luck to all of you. Goodbye. Take care.
Thank you very much, sir.
Okay.
Okay. Thank you, sir. Thank you very much.
Okay. Thanks.
Thank you very much, sir.
Okay. Bye.